A powerful role in all of this is played by the International Monetary Fund. And we've talked a little bit about the International Monetary Fund and the kind of structural adjustment programs that it imposes on countries facing balance of payments deficits, unable to meet their international obligations. So I won't reiterate that again. Suffice it to say that the basic idea of the International Monetary Fund is that it is a fund in which countries around the world contribute, and in return for that contribution, when they find themselves in trouble, are able to draw on that fund to bail them out of their debt obligations problems. And when they draw on those funds, essentially the IMF comes in, sends its experts in, to determine why the country got in trouble to begin with, and to recommend certain types of policies in order to bail them out. As such, it is intended to be an agent of stability, of international stability in the flow of finances. But it likewise has been accused of being essentially a tool of US imperialism in particular, in large part because of the prominent role that the United States plays in funding as well as administering the IMF. And indeed, as your text points out, studies of the IMF came to the conclusion that whether a country receives an IMF loan is to a substantial extent related to political considerations. They came to that conclusion by comparing the chances of getting a loan from the IMF to your stance in the General Assembly and the UN in terms of voting pro or against the US-backed proposals. If you consistently back US proposals, you're at least 3 times as likely to get a loan from the IMF than if you're neutral, let alone if you're opposed. So there are considerable political considerations attached to that. Financial crises, of course, are a recurring theme in international politics. Just in the last couple of decades, we saw financial meltdowns in Latin America that I've talked about fairly extensively. In the 1980s, a severe financial downturn among the East Asian tiger economies in the late 1990s, a financial meltdown and default in Argentina in 2001, and most recently, of course, the US itself was hit by a financial crisis. The financial crisis of the United States derived from the fact that the United States emerged from the Second World War as by far the biggest lender on the international scene, by far the biggest creditor on the international scene. A situation that prevailed until the 1960s, essentially until the Vietnam War. During the Vietnam War, the American government was rather reluctant to raise taxes to pay for that war, in part because they were fearful that raising taxes would slow down the economy and have other negative effects, and consequently preferred to borrow on international markets in order to meet the expenses of the Vietnam War. By 1972, it reached a point where the Nixon administration in Washington came to the conclusion that the United States was no longer able to meet its debt obligations, and for that reason announced what became known as the Nixon Shocks, which is that Nixon announced that the United States would remove the US dollar, the reserve currency in the international system, from the gold standard. Up until 1972, the US dollar was pegged to $20 to the US, or to an ounce of gold, and all other currencies were pegged to the US dollar, either on floating exchange rates or on pegged exchange rates. We'll talk about that in a bit more detail next week, or 2 weeks from now, rather. In 1972, in large part because the United States did not have enough gold to be able to pay its creditors, they simply announced that they would no longer allow the dollar to be convertible to gold, and that the US dollar would henceforth float in its value against the value of gold. Thus, the price of gold suddenly increased drastically, and the exchange rate of dollars declined. And since all of the debt that the United States owed to other countries was in the form of US dollars, they were able to pay those debts in far less valuable dollars than the ones that they borrowed, which certainly did not endear them to many of their lenders internationally. A similar dynamic took place in the first decade of the current century, in that once again the United States found itself involved in military affairs elsewhere in Afghanistan and Iraq. Once again, the government, in this case that of George W. Bush, came to the conclusion that raising taxes in order to pay for these wars would have negative economic implications, and therefore preferred to borrow internationally rather than to raise taxes to pay for or cut spending domestically in order to pay for the wars. And consequently, the U.S. borrowed heavily, became by far, once again, the biggest borrower in the international system, owed, among other things, $1.6 trillion to the Chinese government at this point. Not all of that as a result of lending, quite a bit of it because of the balance of trade deficit that the United States has with China. But this all meant that at the same time, the domestic economy was overheating. Overheating in a number of different ways. Well, in rather peculiar ways. As a number of economists have studied the U.S. economy, one of the things that they came to the conclusion of is that consumers, most Americans, have had declining incomes, largely since the end of the 1970s. And declining incomes would, one would think, lead to declines in consumption. But that didn't appear to be happening. Instead, Americans throughout the first decade of the current century increasingly made use of their credit cards. In other words, debt was building up drastically. On top of that, banks were once again in desperate search for places to invest their money that would pay a handsome dividend, that would pay handsome interest. And all this borrowing essentially pushed up the prices of houses. And by pushing up the prices of houses, allowed people to borrow more money against the increased value of their houses. And thus what began to happen is that people they bought a house at $200,000, got a mortgage for $200,000. 3 years later, it was worth $400,000. They still had a mortgage for just $200,000. Well, they can borrow an extra $200,000 against that house because they've got all that equity in it. And banks would be more than willing to lend that money because the assumption is that if they go bankrupt, we just take the house, and the house is worth more than the money that we loaned them for, and therefore there's no risk involved. Thus, banks poured more and more money into the housing industry in the form of various kinds of mortgages. And given that assumption, they also started to come to the conclusion that really you can lend money for housing to anyone. It doesn't matter whether they have a job, it doesn't matter whether they're a bunch of alcoholics or what have you. If they get themselves in trouble, all we do is foreclose on the house, and the house is always going to be worth more than what we loaned them for it, and therefore we're safe. And so they started to pump what became known as subprime mortgages, meaning mortgages that wouldn't have been given to somebody if creditworthiness was taken into consideration. In many cases, they knew very well that these people would not be able to pay those mortgages off. And as they pumped more and more money into the housing market in the form of subprime mortgages, what kept happening to the price of houses? Well, there's more and more buyers, and there's a limited supply of housing, and therefore the price of houses kept going through the roof. And since 2003, there were various economists warning that this was a bubble, what economists refer to as a bubble. In other words, that the rise in housing prices is a self-fulfilling prophecy. As long as everyone keeps pumping more money into it, of course housing prices will rise. In the same way that a chain letter will work perfectly as long as you get enough suckers to keep pumping more and more money into it. The second that those suckers you run out of those suckers and nobody's willing to put more money into it, the whole scheme collapses. Now, what made it all worse is that these banks, in part because they were aware of the game that they were playing, started to get the impression that it wasn't a good idea to hold on to these mortgages. And thus started to lump all of these mortgages together into investment products. and then sell those investment products to other banks and to other investments and to retirement funds and so on and so forth. Such that by 2008, when the housing bubble burst and all housing prices suddenly collapsed and people were no longer able to pay their mortgages, nobody really knew who owned those mortgages anymore. They were all sliced and diced in various ways, and nobody knew who had assets, what assets were worth what, and so on. And that ultimately sent the whole international system into a tailspin, in large part because these American banks that were supposedly tightly regulated by the American government had sold all of these investments as AAA investments, in other words, zero-risk investments, to banks around the world. And thus, suddenly, not only banks in the United States, but Deutsche Bank found itself virtually on the verge of collapse. Insurance companies that had heavily invested in these kinds of products, like UBS, suddenly found themselves in trouble. And the whole thing spun entirely out of control. And threatened to take not only the American economy with it, but many economies around the world. An ultimate default and collapse of the banking system was avoided only by virtue of the fact that the government of the United States has been pumping about $1 trillion a year into the banking industry at 0% interest. Which essentially, if you think about it, amounts to them basically buying the banks, nationalizing those banks. But of course, they're not actually running those banks. They're simply providing those credit-free accounts, basically to keep the banks afloat, and in essence, to encourage the banks to start lending again. Why would it be a good idea for the banks to start lending again? Because if banks start lending again, then there will be a renewed demand for housing. If there's a renewed demand for housing, then you can start to reinflate that bubble, and so on. Not that that's necessarily all that good of an idea. But you get the general picture. Financial crises are with us, and even the most responsible governments in the international system can't seem to figure out ways to avoid them. What I want to finish off with today, very briefly, is to look at the final component of financial flows, which involve multinational corporations. And I don't want to spend too much time on that. Most of you are aware of what multinational corporations are. Corporations that have operations in a number of different countries, aside from the country in which their head office is based. And for the most part, multinational corporations have been around for a long, long time. Beginning with companies like the Hudson's Bay Company, the Dutch East Indies companies, and so on, that were part and parcel of the process of colonization. But they play a much more prominent role today than they ever did in the past. Those that advocate in favor of multinational corporations, or that see them as a positive force, argue that multinational corporations have an important role to play in facilitating development in third world states, in developing societies. The reason that they do is because they provide investments in places where no one else is willing to invest, or no one else has the resources. That when they invest, they will insist and will take action to guarantee the stability of those societies. In other words, they have an incentive to enhance the stability of the societies in which they invest, in order to make sure that their investments pay off. When they invest, they necessarily create employment. Investment invariably involves hiring people to do work. And since most developing societies have a surplus of labor, anything that creates employment is likely to raise standards of living. And insofar as these multinational corporations employ individuals, that kind of employment, as economists point out, always has a multiplier effect. Meaning that the worker that gets the check from the company then takes that check, cashes it, and uses the cash to purchase goods from the local farmer, to purchase a car, or get his car fixed by a local mechanic, to get his hair cut by a local barber, and so on. And as such, the money keeps circulating, and thus the ultimate effect of creating that employment is far greater than just the effect on the one person that is employed. They also promote development, in that most investments by multinational corporations require modern infrastructure. And in many cases, the multinational corporations create that infrastructure in order to make that investment profitable. They also provide access to technologies to third world states that otherwise would not be available to them, that they would otherwise have to purchase at high prices. Furthermore, they give less developed countries access to world markets, the ability to market their goods through the institutions of the multinational corporation that they would not otherwise be able to market. Walmart, for example, makes it easy for a producer in China to market their product in North America or anywhere else where Walmart has operations. For that individual producer in China to do so on their own would be virtually impossible. As such, they collectively also modernize the culture of the society in which they invest. That all sounds very good. Unfortunately, it does not convince everyone. Basically, a number of critics of multinational corporations argue that, yes, corporations provide investment. But investment, as I pointed out, whether it's in the form of multinational corporations or in the form of loans by banks, always has at the beginnings a flow of capital into the country, but then eventually a greater flow of capital out of the country in the form of the principal as well as the interest paid on those loans. In the case of multinational corporations, why would a multinational corporation invest several $1 million in a less developed country unless the money that it was going to take out of that less developed country eventually ended up being more than what it had originally invested? Multinational corporations, in that sense, are not charities. And as such, critics of multinational corporations argue that they decapitalize weak regions rather than providing capital. In other words, that eventually the capital flows out of those countries rather than flowing in. They furthermore argue that they often are obstacles to social and political progress. If Walmart invests in Bangladesh because of the cheap labor that Bangladesh is able to provide in producing textiles that Walmart puts on its shelf in Canada or in the United States, Walmart has a very definite interest in maintaining those low wage rates in Bangladesh, and will probably take actions wherever it can to make sure that that stays the case. If the price of wages mushroom in Bangladesh as a result of that investment, it would become self-defeating. There'd be no point in investing to begin with. They furthermore argue that multinational corporations almost inherently exacerbate income inequalities. And one important reason for that has to do with one of the advantages that I cite over here, which is technology transfer. Multinational corporations, of course, do transfer technologies from the first world to the third world. But the problem with that is that technologies that were developed in the first world were developed in an environment in which labor was scarce and capital was cheap, and therefore were designed in such a way as to make use of cheap capital and to economize on the use of labor. Now you take that technology and introduce it in a country like Bangladesh, where the exact reverse is the case. You're not employing a lot of people, but whoever owns those machines is going to be making a lot of money, meaning the income that's generated goes to a very small group, a far smaller group than would be ideal for an economy like that of Bangladesh. And as such, they exacerbate income inequality rather than diminish it. All of these things combined mean that overall they discourage development and enhance dependency. And that as such, multinational corporations are a modern form of cultural imperialism and cultural homogenization. Cultural imperialism, in that they essentially play the role, or a very similar role to that played by colonialism in early eras. Cultural homogenization, in that essentially they erase cultural differences within the countries within which they invest. Best example of that is McDonald's. the very claim to fame of McDonald's is that you can walk into a McDonald's anywhere on the planet and order a Big Mac, and it's going to be exactly the same as the one that you're used to getting in your local McDonald's. There is no difference. That's the very idea of that kind of standardization. It erases local and cultural differences. And as such, McDonald's has been immensely successful in changing the diets of people around the world, not necessarily for the better. And for the most part, in the competition of whether McDonald's will adjust to local circumstances or local circumstances will adjust to McDonald's, McDonald's has won out in every case except for two. Can anyone think of two examples in which McDonald's was forced to adjust to the requirements of a local market rather than the other way around? Yes. India. Why? India is populated by almost, I think actually more than half of the population is vegetarian. And even the part that isn't vegetarian isn't going to feast on beef burgers because cows are holy in Hindu India. So McDonald's was not going to make it there unless, as indeed they did, they introduced, I think they called it a Swami burger or something like that, or the Karma burger, which is vegetarian. In that case, they changed. The other instance is Israel, where essentially they offer kosher varieties of their food. But that's the only concessions that McDonald's has ever made to cultural differences. I would say that McDonald's is in that sense not atypical. It's basically the claim of most of these fast food chains is that, and indeed the policy of these chains, whether Pizza Hut or Mr. Sub or what have you, is that the product should be the same regardless of where it's located. As such, they are not franchises in which they simply provide the label and allow whoever runs the restaurant to do their own thing, but ones that impose a particular kind of a product on any subsidiary that makes use of their logo. Okay, let me leave today's discussion of finance at that. I hope I did not overstay my welcome once again.